Hello, this is Megan Horniman, the Director of Portfolio Strategy here at Verdence Capital Advisors. And we're coming to you today to discuss the white paper that we released on Monday evening concerning the market turmoil that we've seen with the coronavirus. What we do know is that the coronavirus is a global health risk. What we do also know is that it has a relatively low mortality rate and it has a very high recovery rate. It is impossible to put a definitive number on what this virus can do to either the U.S. economy or corporate earnings. And that's because the U.S. economy is very consumer-driven. It's also service-oriented. So the impact on growth is highly dependent on how much the consumers stop spending. When it comes to earnings, it's also very difficult to quantify because while some areas and industries in the U.S. economy will be negatively impacted, there are other areas that will be positively impacted. So at this time, it's very difficult to put a number on either what this will do to growth or corporate earnings. Fear and panic are taking over some of the most important investment philosophies, and that's logic and discipline. The daily moves and even the intraday moves are only cementing the fact that global investors do not know how this will all shake out. In the fixed income market, you're looking at yields at record lows. This is purely illogical and irrational. The Federal Reserve has cut interest rates by 50 basis points, and while that can be viewed as proactive, it's also setting a dangerous precedent because that can have an adverse effect of affecting investor confidence. Investors may simply think they've got nothing left if the economy does take a steeper downturn. The equity market, we've seen volatility rise to the highest level we've seen since 2008. We've actually seen circuit breakers, which temporarily halt trading on the U.S. stock exchanges triggered on Monday. It's the first time since 2008. This is panic, disarray, and this is not logic and discipline. Now that we've highlighted a lot of the things that are unknown at this time, we want to give you 4 things that we believe in. The first is that the U.S. economy came into this global health crisis on very solid footing. A solid labor market, wages are rising, consumer confidence is high, and we're actually starting to see some stabilization in manufacturing. Also, you have to remember that the things that are happening because of this crisis are resulting in very stimulative things for the economy. The Fed cutting interest rates, lower oil prices, a weaker dollar that helps our multinationals because our goods are more competitive. The second thing we know is that panic is purely unpredictable. We cannot pinpoint a bottom in the market, especially when algorithmic trading is exacerbating the moves on a daily basis in heightened periods of volatility. What we do know is that if interest rates continue to race to zero, if oil prices don't stabilize, and if the government doesn't come forth with some additional measures to combat this virus, that we will see continued periods of volatility. Third, we continue to like stocks over bonds and short-term bonds over long-term bonds. We just outlined all of the stimulative policies that are going to come forth because of the effects of this virus. This is very supportive of equities. In addition, there's almost 100% of the S&P 500 companies that are paying a higher earnings yield than the 10-year Treasury. This is supportive of stocks over bonds. Now, when it comes to bonds, you have yields, long-term yields at record lows. You want to make sure that you're invested in short to intermediate bonds and do not have exposure on that long end of the curve. Fourth, we continue to like alternatives. Low volatility hedge funds can help in periods of heightened volatility. And then private equity is a very good way to get great risk-adjusted returns, but not have to absorb the daily volatility and the daily swings that you see in the public equity market. We completely understand that the daily moves and the very rapidly moving headlines are difficult for any investor to stomach. However, we will always look at all of our clients' risk objectives. We'll focus on a long-term time horizon. We'll add value or make changes to asset allocation as we see necessary, and we'll continue to look at the underlying fundamentals and what that may mean for asset allocation. Now, with that being said, if you have any questions at all, please feel free to reach out to your financial advisor. Thank you.